you said VC is not really debt, but in a lot of ways, VC performs that form of equity looks a lot more like debt
Yeah.
than typical equity. Can you break that down a little bit?
So I see VC as, and this is why it's always about like towing this fine line. VC can be good or bad debt, but the debt is in relation to, it isn't in relation to you owing somebody X amount of dollars that you have to pay back at interest over X amount of years. The reason why I say VC can be good or bad debt is because imagine if you spent 3, 4 years working on a company, you raised 5 funding rounds, however many funding rounds you raise, and your company's valued at $200 million. Another company comes out of the blue and is just like crushing it. You guys somehow stall out and like you end up selling that company for less than the valuation or at the valuation that the VCs invested in. You now get no money, but you spent the last 4 years of your life building something without any takeaway other than I got experience building a startup. Let me go again. And a lot of founders will like kind of fall into this loop of like, oh man, VC is the greatest thing ever. But you truly have to understand that as a founder, if I go out and raise at a $200 million valuation and I sell the company for $300 million, I'm not walking away with virtually anything, right? Like all the VCs have to be paid back first before I get anything. And normally these deals aren't just, hey, we're going to give you $300 million cold hard cash. It's you're getting acqui-hired and now your equity in the previous company becomes equity in the new startup that acqui-hired you. So now you're still back on the hamster wheel of hoping that the startup that you now have to join. So you go from CEO to being an employee of a new startup that you got acqui-hired at. And then you're still hoping that one day this figurative equity is worth like legitimate dollars. And there are other sides to the VC game as well, right? Like there's been instances where startups and founders, they do find some sort of like private small exits and not really selling all of your shares. But if you were to go raise money for a company and like you get to a point where you can raise at a $500,000 valuation, a lot of the times founders are offered permission or granted permission from the VCs in their rounds to sell a little bit of that equity. So like, let's say you own 30% and you're going to raise at a $500 million valuation. Sometimes VCs will be like, hey, you can sell 5% of your equity in this current round. So you have a little bit of like a cushion, right? So then there is like a thing of like, okay, well, maybe you can walk away with, 5, 10, however many millions of dollars by selling some of your equity. But it's just important to know that the people that are in those positions to become $500 million companies are so far and few between. And that's why you'll see VCs say, hey, we believe that if we invest in 100 companies and like one or two of them become major unicorns, they pay back the whole fund and then some. But it's not one of those games where like you raise money and to your point, Ben, you're at the finish line. Raising money almost like opens up an entire can of worms of this new start that you now have to undertake. And to me, if a founder doesn't see this as like a lifelong vision to bring something new into the world or really optimize from an industry that is struggling, it's going to be very hard to like want to go venture and stick with it because the mindset that's needed to build a company that's generational is just absurd.
Yeah, it's a different beast. 110%.
Yeah.
It totally makes sense. For people who are on the outside, I think there's a lot of entrepreneurs that always debate, should I pursue VC money? How much of the company do you typically have to give to get funding from the ground?
So normally in most cases, you're kind of at each funding round, you're giving up anywhere between like 10 and 15%.
Okay.
Depending on how much leverage you have, sometimes you can give up less, but it all depends on like, what are your revenue numbers? What does your traction look like? How much are you growing month over month? That's a very big one. Month over month growth is super important. A lot of startup founders don't pay attention to it. They'll be like, hey, we're making, 16K a month in recurring revenue, but you're not including like churn. You're not including like overall headcount growth if you're trying to scale and grow faster. So month over month growth is probably one of the biggest metrics I look at. And when you're talking about like how much you would dilute, right? Like when we were raising our seed round in 2021, we diluted like, I think it was like 14.5%, which to me wasn't bad. It's pretty standard, but it all depends on leverage. I've seen companies dilute as little as like 3 or 5% and raise at crazy valuations, but they had insane leverage to back that up versus like if you have little to no leverage, you might be diluting 12% in your first funding round, right?
Mhm.
Like it all depends on where you stand with the investor and how much they think they can get out of you and how much you think you can get back or claw back equity wise. So I would say don't be afraid to dilute 10 to 15% if you really, really need the money and you think that you can make something incredible happen. But the goal is like optimize for the best partners and the best people. Get angels that work in the industry that you are trying to sell into so they can help be kind of your leeway in. Have the right people on your cap table that are going to help you market and distribute and provide like sound advice when you're in moments where you need additional help, because a lot of what venture is people who have already gone through it investing in people who will go through it in the future.